Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Seana Smith alongside Brad Smith. Let's bring you the three things that you need to know this morning.
Good morning, everyone. First up, stock futures wavering this morning after the S&P 500 closed lower in Monday's session, extending its decline after the benchmark saw its worst sell-off this year. Investors grappling with potential growth headwinds here posed by the Trump administration's tariff plans, which the president said are, quote, on time and moving along very rapidly following an initial delay.
Plus, investors digesting the latest earnings ahead of Nvidia results tomorrow. Home Depot rising this morning despite the world's biggest home improvement retailer expecting sales to rise by less than expected this year as consumers remain cautious on large home projects. Meanwhile, Nvidia out tomorrow after the bell. Investors will be closely watching for the potential impact of chip curbs on China following a Bloomberg report that the Trump administration is looking to toughen Biden-era rules.
And the sell-off in crypto gathering steam this morning, with Bitcoin dropping below 90,000 to its lowest level since November. Macro pressures on risk assets fueling the drop, as well as souring sentiment following the biggest ever crypto hack targeting exchange Bybit. Stock futures wavering this morning after stocks struggled to recoup losses following Friday's sell-off here. We're taking a look at some of the pre-market activity. We are mixed right now for the Dow and the S&P 500. We're in positive territory. However, taking a look at the NASDAQ, still got a little bit of catch up on that one. It's flat, but to the downside here. I guess you could say the S&P 500 as well is flat here. We're getting even more earnings rolling out. We're going to dive into one of those big names here, but ultimately, as we think about what the markets are continuing to try and weigh and ultimately prove resiliency through, it is a lot of the tariff talk and the will they, won't they ultimately roll these out at the start of March. That is the core dates that we're continuing to look at here, and especially as even more of the geopolitical conversations are taking place. Macron taking a visit to the White House as well. All of these things considered, it's all about the tone that the president looks to strike and then what that could potentially mean for some of the additional tariffs he looks to levy in some of the negotiation tactics that have been rolling out within the first, it's only been a month. Just 4 weeks since the inauguration.
It's like a long month. There certainly has been no shortage of headlines, no shortage of topics for us to talk about. But I think what's interesting here in the market reaction that we have seen, the market action that we've seen over the last couple of trading days is more this risk-off sentiment. Yes, you are seeing the Dow right around the flat line. You are seeing the S&P hover there as well. But again, you're looking at tech under a bit of pressure with the NASDAQ on track to open the day in the red. You take a look at the move to the downside when it comes to Bitcoin, some of the crypto related trades. Yes, obviously, certainly that is a headline driven and very much market specific. Maybe when you dig underneath the surface and see some of the headlines that is driving and that move to the downside there when it comes to the hack and ultimately what that means here more broadly speaking. But I think when you take a look at the equity market, when you take a look at the fact that yields right now are the lowest that we've seen since December, we certainly have seen this risk-off sentiment certainly creep into the markets. And we're seeing more and more strategists point out in their notes over the last week or so just about a little bit more concerned about the slowing U.S. economy right now and whether or not this is the start of the trend, if this does continue for another month or two, just ultimately what that signals just in terms of whether or not the market's going to be able to continue to shrug off some of these slowing concerns.
Yeah, you talk about those strategists. We got a note just this morning as well from UBS, and their chief investment office continues to expect volatility. However, they are believing that the markets are likely to refocus on fundamentals, they say, that should support the equity rally further here. Three of them that they're really pointing out here. One, China internet remaining attractive on solid fundamentals, they say. Tariff headlines should be considered in the context of broader U.S. economic health. And then lastly here, the third to round it out, AI rally, they say has further to go. And that next test could be just later this week when Nvidia reports.
Let's talk about that because chip makers are wavering this morning after dropping on reports that the Trump administration is planning to expand efforts to limit China's technological advancements. The clampdown would include tougher semiconductor curbs and pressuring allies to escalate restrictions on China's chip industry. With us now for more, we want to bring in Ben Bajarin. He is a Creative Strategies CEO. Ben, it's great to have you back here. Great to have you on Yahoo Finance. Let's talk about how much is at stake here for the AI trade. Obviously, obviously, when you take a look at the report that we will be getting after the bell tomorrow, what is that indicative of? Just how critical are NVIDIA's results to the overall momentum of the AI trade?
Yeah, I mean, I think, anybody who's followed NVIDIA long enough knows that, their CEO, Jensen Huang, has a pretty good point of view of where things are going. I think they're a very good predictor of demand. They obviously see their roadmap and what their customers are looking to do, not just buy GPUs, but to really run that software and what future models will look like. So I think, regardless of whatever the estimates are, I mean, I've seen everything from, flat to strong beats and raises, right? The bottom line is the demand for GPUs remains incredibly strong. And I think a lot of people are going to be looking for that commentary as to how do they set the market and how do they maybe talk more about full year demand, what they're seeing, because I think a lot of people still have a lot of questions about full year. And I think Jensen's going to be in a position to bring a lot of commentary to that as well. And, a lot of what he says will help seed and bring some lift to that market, not just this quarter, but really for the rest of the year.
Ben, when we do see dips in AI-related tech stocks here, how can investors aptly decide or make sure that they are evaluating the difference between quality AI stocks versus those who are just slapping AI on something and saying, hey, we're leveraging it and it's going to prove to be more efficient for us?
Yeah, I mean, I think there's some fundamental technology differentiators that any good play here is going to have, right? I mean, semis is one of the biggest ones, as you see, and you see some of the most popular names, not just being Nvidia, but being Broadcom, Marvell, obviously AMD's in there, and I think people want to see more in terms of what Intel's got up their sleeve, not just from product, but also manufacturing, because manufacturing AI chips, as we've seen with TSMC, another one, right, ASML, these are fundamental companies that at a technology level aren't going anywhere and provide, critical underlying technology for the AI industry. I think there's some other elements in software that's going to be interesting. I know a lot of people talk about when are we going to see monetization in software from the hyperscalers. Everything we hear in terms of numerous CIO, CTO conversations continues to suggest that those enterprises will start to move from pilot to full deployment at scale toward the end of this year and into 2026, which again means that you've got to have all of that infrastructure in place to start inferencing at scale. So we think you're going to continue to see that wave, and I think there's those hardware and chips and then software and the hyperscalers and others where they're going to start monetizing this infrastructure toward the end of this year.
Ben, when you take into account the reports that we're getting, just that the White House could potentially crack down even further on some of these chip export controls, what's the ultimate impact, do you think, to some of the leaders within the space?
Yeah, I mean, the big thing, like we've seen with tariffs in the past, is really just going to be an impact on margins, right? We don't think that this is going to slow down the sales of any of these things. And I think, when you look at the demand versus sales in any quarter, right, the big thing is just to say, like, well, we're not losing sales. They might be pushed to another quarter. They might be delayed, but they're not lost. And I think that's the part of if somebody decides to not buy this quarter, but next quarter, or whatever those dynamics are, we just continue to see so much demand for AI infrastructure, and we believe that will continue, that it's really going to be a margin question, which then comes down to who has margins to give. And there's a handful of companies, there's not many, but there's a handful that can absorb those. And there's many where that will be more margin pressure, which will have a much dramatic impact on earnings.
What do you think DeepSeek exposed about the AI trade right now, or perhaps even about some of the froth that's around the trade?
Yeah, I mean, the biggest thing is it doesn't change anything in terms of demand. I mean, I think we have been wanting cost per token, right, from an inference standpoint to come down for a while. That's been predicted for years. The question was when we'll see models that can do things which we call reasoning or long thinking types of models for inference. Everybody wants these costs to come down. To be honest with you, we need those costs to come down so enterprises can move from project to deployment, right? Because if you just think of how many people in your enterprise are going to be querying or inferencing, doing any type of agentic research on a daily basis, if you're paying whatever 10, 15 cents per token, that could get pretty expensive. If you're paying 1 cent per token, that's much more economically friendly for your enterprise. So we want those costs to come down. Those costs come down so consumers can use Gen AI. Everybody who wants to monetize and have ROI on this needs those costs to come down. And that was the positive from DeepSeek, is that it really can do deep thinking, high forms of logic at lower cost and at efficiency. And I expect every model to follow suit, which will be very, very good economically for this industry.
But very much so going into this and ahead of the DeepSeek revelation and some of the advances that we learned about, NVIDIA very much viewed as the golden child almost when it comes to the AI revolution and adoption. Does DeepSeek at all change that?
No, I don't think it changes anything. I think, again, what you're going to see is more models follow suit. I think the big positive here was really just the opportunity for open source. This has been a real big question. When you look at any enterprise survey today in terms of those enterprises I was talking about who are in project mode, it's like over 70% of them are using OpenAI, which is a closed model. So if that continues, great for OpenAI, great for Microsoft, who will benefit from the bulk of that infrastructure. But the reality is there's a lot of enterprises out there who will take a very good model that is more open source, that they can tune themselves and deploy either on-prem, on-device with AI PCs or AI smartphones, and those need to be open source. So I think what that did was just bring this question back to what does open source mean for this industry? Again, we don't know the answers. We're still in maybe inning one of the AI momentum that we have here, but it's good for open source, and we hope Meta does models there, Amazon has others. We hope that that's good. To just bring more variety and more competition to the LLM space.
Ben, just lastly while we had you mentioned Intel earlier in the chat here, and I just wanted to get your outlook for what the recovery story looks like for this business. It sounds like you believe there could be a recovery story. Is it a sum of the parts that ultimately then gets put into some type of deal conversation?
Yeah, I think you've always got to look, right, as the product portfolio, the whole sum of the parts, like you said, of Intel. I think there's two things going on that we should be really focused on. One, what are their technology differentiators from a foundry standpoint? I followed this rumor around TSMC and others as a joint venture, and when you looked at how people were valuing Intel, or at least how they were valuing foundry, they were valuing its book value really just in assets. There was no much percentage of increase on that in terms of what a deal could look like for core IP. Yet at the same time, we know that Intel Foundry has a lot of very good core IP that they've been developing, and that should be worth something. And so I think we've got to take into account what are they doing with underlying manufacturing technology, things like power via, innovations in backside power, what they're doing in transistors, in design. We need to think about that the same way that we think about what TSMC brings to the table that differentiates their customers to go and compete and design products. So it's a foundry story. And then I think a lot of people honestly miss that the CPU is still highly relevant to AI infrastructure. It's one of the most critical parts to reduce latency, to manage the orchestration layer. And so I think we forget, we get really caught up in GPUs and custom ASICs, and those are all great. But you look at what's going on, and AMD and Intel are both in this case, is that there's actually a really nice upswing for designed CPUs that are built from the ground up for AI. And we don't have those yet. We have legacy CPUs running AI. And eventually both those companies, I think, will participate in the CPU side of this side as well, and be able to charge higher prices and play a more critical role just from the CPU side. So I think from Intel, you've got both of those. You've got product with a lot of opportunity, and you've got foundry with a lot of opportunity. But the point is, it's a long story. I think that's what people have been frustrated with Intel is it's going to take time. It's not next year. It might not be the year after. It's more toward the end of this decade. And I just worry people lose patience.
We didn't even let you know that was a topic we were going to talk about. Ben, appreciate it. Thanks so much.
Yeah, thank you. Thanks for having me.
Certainly. Home Depot narrowly beat sales expectations in its fourth quarter. The home improvement retailer posted positive same-store sales growth for the first time since 2022. After 8 straight quarters of declines, here with more on the results, we've got Yahoo Finance's Brooke DiPalma. Brooke, what do we know?
Good morning. Well, investors were certainly excited about that same-store sales growth, the first positive results that we've seen in 2 years from the home improvement retailer. But investors also a bit disappointed when it comes to a cautious guidance that the executives set out amid higher interest rates and stubbornly high interest rates that are really causing consumers to continue to push off those larger projects. And if we could take a closer look at that 2025 guidance here that disappointed investors, total net sales expected to grow 2.8% in fiscal year 2025. We also know that same-store sales growth expected to increase just 1%, and adjusted diluted earnings per share expected to decline approximately 2%. That's really causing some disappointment among Wall Street this morning. Now, sources that I've spoken to this morning said that did prove a bit conservative amid this uncertainty within the home improvement sector, but executives are hoping that consumers ultimately get used to these higher interest rates and pursue these higher projects, or rather higher higher ticket projects that they've been pushing off. Another thing is that exciting same-store sales growth that increased 0.8% in the quarter. Once again, that is positive results for the first time in 2 years, and that was largely boosted by Hurricane Milton and Hurricane Helene. That boosted results by roughly 60 basis points. It also reflects growth within their pro-heavy categories like roofing, drywall, and lumber. Also strength in e-commerce. That was up 9% for the quarter, and all that really led to positive foot traffic. That increased 7.6%. That's the best foot traffic that Home Depot's seen in a quarter in nearly 3 years. That's compared to a decline of 1.7 in the prior year. Now, one thing that has Wall Street also excited is this acquisition of SRS that happened last June. We're currently listening to the call, but CEO Ted Decker said so far in the call, he called it additive and complementary. He also said that it contributed $6.4 billion in sales for the first 7 months that it's owned this distribution for residential professional customers. So really focusing in on that pro business here. SRS is expected to bring in, grow mid-single digits as far as organic sales grow in fiscal 2025. So lots of excitement around the pro business, but consumers still pushing off those higher ticket DIY projects.
Well, they'll be very pleased to know that DIY projects for home improvement are very heavy in my algorithm right now. I don't know why. I don't even have a home.
What do you have in the pipeline that I don't know about?
Nothing. Just an IKEA Billy bookcase in the shopping cart.
That is exciting.
Yeah.
Gotta start somewhere.
Yes, you do. All right. Well, Brooke, thanks so much for starting off our day like this. As we head to break, let's get a check-in on shares of Palantir. PLTR is the ticker symbol. We are taking a look at shares right now. Pre-market up by about 1.7%. However, that is not going to be enough to erase the slippage that we've seen over the past few sessions here as PLTR shares have been down, especially on some of the reports about cost cutting at the Pentagon and more broadly what efforts the Department of Government Efficiency might put forward in order to try and slash some of those costs. The slippage has been bad over the past 5 days, down 25%. We'll continue to track that going into the opening bell. We've got much more ahead on Morning Brief. It's now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, shares of Hims & Hers plunging after the company confirmed it will stop selling compounded versions of weight loss drugs. And as analysts cite an uncertain year ahead, Yahoo Finance discussed the results with the company's CFO. Take a listen.
We do fully intend to abide by all regulatory requirements, and when necessary to do so, we'll remove all commercially available dosages of semaglutide from the platform. So embedded in our guidance is after the first quarter, assumed in our guidance is no revenue from commercially available dosages of semaglutide.
And as we're taking a look at shares here this morning, we were continuing to track that slippage here for Hims & Hers. One of the other things that came up within the period, even though they did demonstrate some robust revenue growth, 69% year-over-year increase, it's still more about the outlook here that they're communicating to the analysts and the street here that's rattling or ruffling some feathers right now.
Yeah, it certainly is, especially when you compare that to the reaction that we're seeing in names like Novo Nordisk. You're looking at shares pop there on the heels of what we're hearing from Hims & Hers. You're looking at the highest level that we've seen since late December. You're also looking at Eli Lilly moving to the upside. Of course, much of that is because of the fact that Hims & Hers will no longer be selling some of those compound weight loss drugs, obviously, after the fact that it's no longer declared a shortage. I think the big question for Hims & Hers right now is just what exactly that growth trajectory looks like, right? Without the demand and without the revenue from the compounded drug, just ultimately what that looks like. Obviously, a bit concerning here for investors. That's clearly reflected in the share price. But remember, this is a stock that has come so far, so fast, especially when you take a look at some of the short interest even involved in a name like Hims & Hers here most recently. And when you take a look at some of the gains over the last year, it's just been incredible to watch here. As I pull up the 1 year chart, I believe we're looking at gains here of just about 438%. Even since the start of the year, you're looking at gains of over 100%. So again, obviously coming a bit back down to earth. You look at the short interest within the stock, it makes a lot of sense why we're seeing the type of volatility that we are.
Yeah, one of the things that we continue to remind viewers of as well is what is widely regarded as this patent cliff. Between now and think out to, I think, 2033, there are going to be a lot of brand name medications that have had intellectual property, had patent protections that are going to be rolling off. And for Hims & Hers, what they've been able to do is identify which they would ultimately be able to produce, mass produce at scale and quickly get into their own sales ability and take that to market as well at a perhaps lower cost and take that to consumers. And so with that patent cliff, that presents an opportunity. However, in this near term, for the GLP-1s that they had run Super Bowl ads about and tried to make sure that their brand stays top of mind for consumers, it certainly is a longer lead time that it seems like it might take in order for them to be able to capitalize on some of those patent cliff roll-offs here, which could account for about $400 billion in revenue lost by some drug companies here, as evaluated by one of the, I think Morgan Stanley put out the $400 billion figure there. So we could see some M&A, but we could also see a Hims & Hers trying to make sure that they identify which solutions they can then take to market as well.
Let's take a look at PayPal. PayPal making several announcements ahead of its Investor Day getting underway right now. The company predicting growth in earnings and transaction margins in the coming years. Its new leadership team continuing to streamline the sprawling business. You're looking at gains of almost 3% here in the pre-market. There's a clear focus at PayPal, and this has been the case now for some time under their CEO. It's one of sustained profitability, and they're laying out ways in which they see themselves achieving that. Obviously, when it comes to slimming down parts of their business, they also announced plans to unite all of their retail-focused services onto one platform that's going to be called PayPal Open. That is making some progress here. When you talk about some of the other initiatives, clearly 2024 was a transition year for PayPal. So they're emerging from that. Their CEO, Alex Chriss, saying that they executed on exactly what they started out and planned and wanted to accomplish there. So now it's more so about refining some of the priorities of their business right now as they do try to have a real focus on being profitable. And that's something that the street has been very welcoming, obviously, to no surprise, and excited to hear time and time again from their CEO.
Well, I'm helping. I'm doing my part. I'm within this Venmo category here where I always do a Control or Command F, whatever operating system you're using here. But one of the product level expectations that the company had put out, looking for PayPal and Venmo debit total payment volume to be $50 billion and growing at a greater than 25% CAGR, compound annual growth rate, by 2027 here. Also did a little bit more searching on Venmo for all you people out there who are perhaps expressing those funds into your bank accounts and whatnot. Either way, they're expecting about $2 billion Venmo revenue by 2027. That is a low teens compound annual growth rate that they would be looking for as well. And then even more growth within the debit card options for Venmo. So the Venmo category is really what they've been banking on, as that is more prone to carry a lot of younger users that were on the platform. Perhaps not those who are the native or old school PayPal users who are checking out on eBay and then saw the spinoff, which I actually had the opportunity to work on in a past life. But all these things considered, Venmo and the younger users, they are core to these compound annual growth rate expectations for the company right now.
Yeah, they're also touting their ability and where they're positioned within the cryptoverse compared to some of their competitors out there, talking about the fact that they're enabling consumers to buy, hold, and sell digital crypto via their PayPal and their Venmo accounts. And their CEO, Alex Chriss, going on to say that we just enabled hundreds of millions of users and tens of millions of merchants to be able to spend their crypto instantly for their everyday purchases, saying that that is another thing that separates them from the competition.
Have you bought anything with crypto yet?
Nope.
No?
Have you?
All right, maybe this year.
Never know.
Yeah, we'll see.
Never say never.
Finally, yeah, there's a song in there somewhere. Finally, Unilever announcing a leadership change in the coming days. The company's current chief financial officer and 37-year company veteran will replace its current CEO on March 1st. The current CEO will stay on to help oversee the transition until May 31st here. And it doesn't sound like this was entirely expected here. This comes after Heinz Schumacher was in the position for for less than 2 years. The board doesn't sound like they were satisfied with how quickly some of the restructuring was taking place there.
They were, and they wouldn't. I think you can make the argument that they didn't really give him a chance to really embark on this turnaround strategy for being there.
2 years is short
less
for a
than
CEO.
2 years. Yeah, we also know that Unilever has been under a tremendous amount of pressure from activist investor Nelson Peltz. Now, he has been very vocal. Initially, he was very much in support of Hein Schumacher when he initially took over as CEO. Obviously, has had a little bit of a change of heart. So this coming now after the board ousted him as CEO, again, less than 2 years on the job. And you mentioned the fact that this came as a bit of a surprise. RBC saying, quote unquote, that they were gobsmacked by the news. They didn't see this coming at all. So I think that in that line explains it all. All right, keep it right here on Yahoo Finance. You got much more coming up. We've got the opening bell for you when we come back. And that's the opening bell on Wall Street. Let's do a check of the markets as we begin a brand new trading day. You are looking at some gains, I think we could call it there, and be excited about here for the Dow. We are just above the flat line here, up just about 100. But when you see some of the pressure, more broadly speaking, obviously tech still in the red. When you see some pressure from the NASDAQ, you do have the S&P right at the flat line here at the open. Not too much movement here. But the big question here is whether or not we are going to be able to regain some of that momentum. How much of that is going to be hinging on the results that we will be getting from Nvidia tomorrow after the bell. Taking a look at the NASDAQ, under some pressure here this morning, off just about 0.3%. I do want to pull up some of the action that we are seeing in the bond market here. You are seeing this move lower in yields, actually the lowest level that we've seen in yields since the start of the year. So again, when you see that move lower here, we are seeing bond prices move to the upside. And also the VIX, the volatility index, just to call that out, we are around the highest levels, I believe, that we have seen since the start of the year. You pull back that year-to-date chart there, you can see right around the levels that we saw in early January there. So again, some of this move to the upside. And taking a look at the sector action here very early in the trading day, you are looking at a lot of green, or a little bit more green on the screen. You got financials up just about 0.5%, consumer staples also not too far behind. On the flip side, because of the NASDAQ, you're having the tech sector, XLK, that's off just about 0.2%. Utilities, the worst performing so far, just here at the open, off about 0.6%. Jared Blickery is standing by with a closer look at some of that movement that we're seeing. Jared.
Thank you, Seana. Yes, we are seeing kind of a risk market breakdown here, and I'm going to go back to back to the major indices. I'll put a 5-day chart so we can see the S&P 500 and what it has done recently. Yesterday, I think, was very instructive because we started out with a little rally, and then we got into yesterday and the day before's territory, into Friday's price action territory, and then we just sold off pretty hard. Let's take a look now. This is the S&P 500. Let's put a 4-day. Well, it looks like the charts aren't cooperating this morning, so I'll just tell you that the VIX has been up 4 days as well. Small caps leading down today. And let's see if we can get a chart of the 10-year T-note yield, and I'll just put the quotes on. That is down 8 basis points, so 4.32%. We haven't seen that in about 2 months, and that's fairly significant. And I've been highlighting that lower yields are generally good for risk markets, but that's always contextual. You don't want yields falling in terms of a safe haven flight into bonds. Bonds move inversely to yields, so bonds are going up right now. Let's get to the sector action, because not everything is going down. Consumer staples has been going up, but that is a defensive sector, and we'll see if I can get a 5-day chart on that. That has been heading higher, 2.5% over these trailing 5 days. And another sector that's not doing so well, but in the consumer sector, is discretionary. And XLY, that had been down 6 days. Today would be the 7th day, and that is an Amazon and Tesla story. The weakness that we've seen in Amazon, because Amazon is down 6 days in a row as well, that has been a more dominant factor. But we know that Tesla has also exhibited a lot of weakness this year. I'm going to switch over to the NASDAQ 100, and you can see a lot more red than green. Apple has been a bright spot, but I did want to just pull up a chart on Amazon one more time. There we go. That is down 5 days in this chart. It's been down. That would be a 7th day if I'm counting correctly. So some weakness in the mega caps overall, which we can also see in the Mag 7 ETF. And I think that's instructive as well. So the ticker there is MAGS, and we'll see if I can find it on my little screen here. And even if I can't, we've had, there we go. It's down 0.7% today. I'll put a year-to-date chart on there, and you can see how it just broke that support that it held since the beginning of the year. And in fact, that is a 2-month low that we're looking at for the Mag 7. Bitcoin is another sore spot for the risk markets. I'm going to show you a lot of red right there. Bitcoin is down 7.41% over the trailing 24 hours. Ethereum and Ripple, those are each down 10%. But let me just show you the kahuna here. This is Bitcoin. We had a nice, what looked like a base, and you never know if it's a base or a top until it actually happens, but we are now heading down. And the one bright spot for bulls that they can cling to is we have had so many false breakdowns and breakups in Bitcoin, a lot of fake outs. This could just be another one of those. So we'll look for a reversal of this. If it climbs back over 90, 92,000, especially within the next few days, that might just mean this was a temporary washout. And I think that's the best case we can say for the short-term bulls right now. But long-term bulls definitely have the edge, as we can see in this chart. Guys?
Jared, thanks so much for teeing up today's trading activity. Appreciate it. Time now for today's strategy session. U.S. stocks struggled to recover from the S&P 500's biggest sell-off this year on Friday. Still, the benchmark index has gone 36 trading sessions without back-to-back drops of 1%. So will the dip buyers return? That's the big question. Joining us now with more, we've got Michael Reinking, who is the New York Stock Exchange Senior Market Strategist. Great to have you back here in studio with us. I was reading your note at the end of last week and talking about some of the flashing warning signs. And I believe you were looking at the S&P 400 mid-cap, within that looking at some of the consumer staples as well.
Yes.
Where are there still flashing warning signs that you're
Yeah, so I mean, over the last couple of weeks, while the S&P 500 was making these marginal new all-time highs, you continued to see the small and mid-cap indices kind of trading pretty poorly. They couldn't actually break above their 50-day moving averages, right? And then one of the things that I like to watch, kind of at these sort of turning points, is the performance of staples versus discretionary, something that Jared was just kind of talking about, right? And you started to see over the last couple of weeks, you started to see staples start to outperform. That actually really accelerated at the end of last week, and that's despite the fact that you had Walmart trade down 10%, and that's the biggest component within kind of the staple sector, right? So you've seen kind of this flight to safety. You've seen defensive sectors have really been outperforming. You had the S&P 500 was down almost 2% last week, but yet you had kind of the split between kind of sectors under the surface, right? You had kind of all those defensive sectors that were kind of really outperforming.
Do you see that at all changing or reversing, just depending upon what we get from Nvidia tomorrow?
It's hard to put it kind of completely on Nvidia, because I think one of the things that I highlighted that I was watching the mid-cap indices, right? And the mid-cap index is sitting right at its 200-day moving average right now, right? And we've reversed all of those kind of election, kind of all those election gains. I think part of what the market's dealing with a couple different things here, right? We're dealing with a growth scare, as we've seen a lot of the kind of survey data, right, has come in pretty negative, right? We're also seeing negative earnings revisions, right? So we've had a very solid quarter, kind of from an earnings perspective. But if you look at kind of the year, the earnings estimates for the year, right, for the mid-cap index, they're down about kind of about $10. Right, from kind of 205 to the low 190s, right, over since the end of Q3. Right, so Nvidia could help to kind of put a bid back in that Mag 7 and take out some of the concern that we've seen in the unwind of kind of this AI infrastructure trade. If they can kind of convince people that there is still this kind of burgeoning demand, and it could kind of help the S&P 500. But I think for that broadening story to happen, right, we're going to need to kind of work through some of the other issues.
Don't we typically hear companies adjust their earnings forecasts for the year early on in this first reporting period? Why is this time atypical of what we've seen in the past?
Yeah, so I don't think it's necessarily atypical per se. I think that there were very high expectations coming in, right? So we were looking at kind of not only the S&P 500 to show 15% earnings growth rates, but we were also looking at kind of those small and mid-cap indices to show similar growth rates. Those have already been revised down to under 10%, right? And so I think part of what's happening, and this was something we talked about in our earnings preview, is that we would have a solid quarter, but just given the amount of uncertainty, right, that we have from a policy perspective and just an economic perspective, right? Management teams are going to be kind of cautious, right? And so you've seen some caution built into to those kind of earnings estimates through the back half of the year.
Michael, when it comes to some of that risk-off sentiment, take a look at even just, for example, what's happening in crypto this week. Is there more of a read-through on that? Obviously, some of that being headline-driven with hacks and everything, but beyond that, is that a signal something a bit larger here that's at play?
I think you've had this like very crowded positioning, right? So you've seen kind of the retail crowd, and people have just kind of been moving into these momentum assets, and momentum unwinds happen very, very sharply and aggressively. I don't know that it necessarily kind of signals anything, kind of larger outside of a reset, which, in theory, in the longer run, can actually be positive. I mean, it's interesting, to go back to Walmart for a second. Like, Walmart was up over 50% from the end of Q2 heading into earnings last week. Walmart had become almost a momentum stock in and of itself, right? Where it was this kind of place to kind of move within the market. And you saw those, the numbers were pretty solid from a quarterly perspective. Their commentary was pretty solid. The guidance was a little bit light. I think there was some caution built into that as well, right? But you saw the stock get hit, by 10%, call it, right? And that was kind of this kind of momentum unwind, and it's just expectations heading in.
We've made it this entire conversation, and we haven't said the Fed or FOMC. What does that tell you about the prioritization in the minds of the market right now?
Right. Well, I will say that, the move that we're seeing in interest rates right now is concerning. For me, right? I mean, it seems like just yesterday that we were talking about, the move higher in Treasury yields, like it was all but, less than a month ago when you had the 10-year was at about 4.8. Right, we've now come in about 50 basis points, and everybody was worried about term premia and inflation concerns. Now we're seeing kind of those growth concerns, kind of start to bubble back up. I would caution, I think, what we're seeing in terms of those growth concerns, they're all coming from the survey data, right? And if you think back over the last couple of years, the survey data also told us that we were going into a recession, right? Multiple times, right? So that survey data has been, negative as things were positive. We're seeing kind of a turn here and some uncertainty. I think that's kind of an expression of uncertainty. But until we start to see the economic data turn, that hard data start to turn, right? I wouldn't put too much weight into that survey data.
So you're not too worried then, I guess, about some of the weakness that we've seen?
There's concern, right? I think the key is from here, if we do start to get a bounce and we want to see kind of that broadening, like the broadening hasn't happened as investors have hoped in kind of the small and the mid caps, right? It's happened outside of the U.S., throughout the start of the year with Europe outperforming, kind of pockets of Asia outperforming. When we start, if we can get this bounce, because we're at this key technical level and we've been down for a couple weeks straight. If we can get a bounce, you want to see how we kind of interact with some of those, kind of shorter moving averages and see if we can kind of build a base here, kind of for markets to propel higher. I think we have a couple things from Washington that we're, that are kind of top of mind. We have a debt ceiling negotiation. We don't know where Washington policy is. So there is this uncertainty. And we've had kind of the sequencing, which is something we also talked about the last time I was here, right? Thus far, the sequencing has been kind of negative growth, kind of from Washington as opposed to that pro-growth. So if we can kind of move through this piece and then kind of turn the page to some of those more pro-growth policies, that's where we can kind of start to move forward.
All right, Michael, always great to talk to you. Thanks so much.
Thanks for having me.
It's time now for our chart of the day. Let's send it over to Madison Mills. She has a closer look at the moves lower that we've seen more recently in the Mag 7 names. Maddie.
That's exactly right, Sean. The Magnificent 7 ETF is at a 2-month low this morning. You can see here the Magnificent 7 names falling nearly 9% since their peak back in December. And you can see the last time that the Mag 7 ETF entered near correction territory, which would mean a decline of 10%, was back in August during that sell-off that hit below 15%. So we are inching towards that territory. When you look under the hood, it's really interesting to see which of these 7 names are the biggest movers here. here. Tesla is the biggest laggard of the group, falling since its December high, followed by Microsoft and Alphabet. As we've continued to mention, given that 20-session streak of Meta, they are the only member of the Mag 7 that's been in the green during this a little bit of a rout, you could say, that the Mag 7 names have entered here as they near towards that correction territory. But of course, the focus of the Mag 7 this week is Nvidia, heading for those earnings on Wednesday. And I saw this stat this morning that really stood out to me. This idea of, pressures on Nvidia with DeepSeek and cheaper AI has led to a little bit of a sell-off in that name to the tune of $600 billion in the month of January. But we're still seeing investors piling into the stock. $5.7 billion has gone into Nvidia this year. That is more than double the amount of inflows Nvidia saw year to date at this time last year. So we're still seeing some bullishness in the stock. The stock has 90% buy rating from Wall Street. If you take a look at the analyst recommendations on Bloomberg, of course, we will continue to monitor Nvidia and the rest of the Mag 7 as we head into that key chip giant earnings tomorrow, guys.
Key critical report. Can't wait. Maddie, thank you so much. Appreciate it. Coming up, everyone, a disappointing quarter for Krispy Kreme, the key crispy trade here, how the donut chain plans to turn it around this year. CEO Josh Charlesworth joins us next. You see him there, hear him in a moment. Next on the Morning Brief.
Krispy Kreme plunging after missing Wall Street expectations for the fourth quarter, also issuing weaker than expected guidance. You're now looking at losses of just about 22% for the stock. The donut chain's revenue falling 10% from a year ago. Part of that was driven by a hit by a cyber attack in November that disrupted online ordering. So here to tell us more about the road ahead, we want to bring in Josh Charlesworth. He's the CEO of Krispy Kreme, also joined by Yahoo Finance's Brooke DiPalma. It's great to have you both. Josh, when you take a look at the stock's reaction to this, clearly the street very much focused on the miss that we saw the most recent quarter, also the guidance, though, that we are getting for the quarters ahead. What is your message to the street here this morning, given the magnitude of the drop?
Yeah, good morning. Thanks for having me on. This morning we did report our 18th consecutive organic growth quarter. That was actually in line with our expectations, excluding the very disruptive cyber incident we had last year. And then, yes, indeed, we talked about the key messages for this year are about transforming the business into a bigger and a better Krispy Kreme. Our core strategy is working, which is to get those awesome fresh donuts out to more people. And we really focused on the milestones we achieved in 2024 and 2025 to do that in the US through national distribution partners and internationally with franchise partners.
Josh, weather did cause a choppy start to the year. We're also seeing that pair with a value-conscious consumer moving into the year. How do you boost investor confidence right now?
Well, the first thing I'll say is, that strategic focus areas that I already mentioned, such as expanding with national partners in the US, that's continued to grow very well. We achieved a milestone of $250 million of revenue last year, over 20% growth. So that's where we're taking the donuts to people, making it more convenient for people to buy our donuts. What you're referring to, the choppy start to the year, is in our traditional retail shops. Where we have seen the value-conscious consumer also pressured. What's great is we've got the beloved original glazed donut. It's our most affordable donut, and we're bringing everyday value to our customers with that. So, the strategy's working. It's a choppy start to the year, but as we prepare for this national rollout in the US and indeed international expansion, we're confident for the long-term profitable growth.
Josh, all due respect, the stock's at an all-time low here today. How do you essentially believe that the strategy is going to translate through to shareholder value?
Well, our focus is on getting the best out of the of this profitable model that we've already established. But we're in a change phase right now. We're investing ahead of achieving that national rollout. We are expanding with national partners like McDonald's. We added Target last year. We announced this morning we're adding Costco. What's important is as we build out from being a regional player in the US to being a truly national player, we need to make sure we do it in a sustainable, streamlined way. As you can imagine, just selling the donuts out of the front of the shop versus actually running a more sophisticated food distribution system means that we need to go through change. We need to transform so it's sustainable long-term growth, and that's our focus today. We also announced on the international side looking at international franchise partners, and that news today also we know will bring shareholder value to your question.
I'm glad that you brought that up because I also highlighted that in my notes here. You said that you've begun that process to evaluate refranchising certain international markets, essentially when companies sell corporate-owned stores to franchise partners there, or franchisors, or franchisees rather. Which geographies specifically are you targeting in the rollout of that?
Well, for that, we're focused on international. It's incredible. Krispy Kreme, actually, from a system-wide sales point of view, is as big internationally as it is in the US. And we're in 40 countries around the world, largely with franchise partners. But we do have some markets that we are company-owned, UK, Ireland, Australia, New Zealand, Japan, Canada, and Mexico, where we think that going forward, the fastest way to grow, the most capital-efficient way to grow, is to do it with national partners like we've seen in those other international markets.
Josh, some of the commentary that you mentioned on the call, one of the things that stuck out to me was the fact that you called it choppy right now, just in terms of the sales so far this year. You talked about the weakening consumer spending. How much of that, in your view, is a result of inflation?
Most of where we've seen that is in the traditional retail outlets, and indeed back in 23, we did take pricing on our donuts. Initially, we didn't see an impact. So, more broadly, obviously, the value-conscious consumer is under pressure right now. Interestingly, where we're bringing the donuts to people rather than having people come to them, where we're putting those awesome fresh donuts right in front of them by the checkout in Walmart, now Target, or indeed a McDonald's. We just launched in McDonald's today. Where we're bringing the donuts to them, we're not seeing the same impact.
In terms of that partnership with McDonald's, what is the price point difference between what you sell at a Krispy Kreme store versus what you're selling at these partners? And what does volume look like? And do you plan to close more underperforming stores and really invest in these partnerships more so?
This McDonald's partnership is an exciting one. We've already got, even though we just started in October, to 2,500 restaurants, and we know the feedback from McDonald's has been positive. We're now looking to roll out to 6,000, indeed 6,000 by the end of this year, indeed 12,000 by the end of next year. So it's an important program for our growth. The donuts are freshly made. They are delivered daily from our hub and spoke network. So they're very similar to what you get in a Krispy Kreme store, but not the same variety. The price points are not dissimilar from what you would get at our donut shop, but at our donut shop you get some of our latest specialty collections as well. So there's some variation there, but it's all in the strategy of just bringing donuts to more people.
Josh, Brooke, you managed to do it. My stomach's officially growling. I appreciate it. Thanks so much.
You bet.
On the other side of the break, more trending tickers on the Yahoo Finance site. Those stories next when Morning Brief returns. We're taking a closer look at some trending tickers this morning. Let's go. Eli Lilly cutting prices for its blockbuster obesity drug Zepbound as consumers flock to cheaper alternatives. Lilly also announcing the launch of the 7.5 and 10 milligram single dose vials.
Plus, Keurig Dr. Pepper rising after a top and bottom line beat in the fourth quarter, sales climbing as the company sold more products at higher prices. Areas that missed estimates include coffee sales and international sales.
Finally, Zoom falling on a weaker than expected outlook for 2026. Video conferencing platform just missing revenue estimates for the full year. Operating income barely meeting expectations.
All right, well, that does it for Morning Brief. Keep it right here. Catalyst coming up next.